Hi everybody, my name is Mary Redmond and I'm talking again about the Australian dollar US dollar pair. And looking at all the currency pairs, particularly the commodity ones, Australian dollar really seems to offer probably the best downside potential. And the pair also has a lot more volatility than the US dollar CAD or one of the others, and it also tends to move very closely with commodity prices and the stock market and general risk appetite. So it can be a very good pair to trade. And I still favor the downside on this. I don't think that we've seen anywhere near the true downside that we're going to see in the next several months in the second half of 2011. And there are several fundamental reasons why this is happening. It all seems to be coming together and point towards a general slowdown in the Australian economy for a number of reasons. The commodity prices, which have been on a tear, really made a substantial correction this week. Oil prices broke below 100. Gold prices are showing a very interesting pattern. It's showing a very clear wedge here, and this is a wedge which is likely to break out one way or the other in the next several weeks. And people can take their cues from that. Also, I talked a couple of weeks ago about copper prices. Well, the copper prices look as if they're really starting to roll over to me. And the 6-month copper, the 1-year copper, and even the shorter terms, they really don't look as if they're making breakouts to new highs. They look as if they're rolling over in anticipation of what could be a possible slowdown. And there are a number of reasons for this. China this week released its CPI. Its annual CPI was 5.3%, and its producer price index was 6.8% on an annual basis. Well, that's still way above their targets, and that's an inflation rate that's considered dangerous to the Chinese, and they went ahead and raised rates again this week by 50 basis points. So that could be impacting the commodity prices, as well as the anticipation of a slower or a cessation of quantitative easing by the Fed. And it also could be impacting some of the statistics we've seen out from Australia this week. We saw a very bad employment number. The full-time employment was negative 49.1 thousand in Australia. That's one of the worst that we've seen in a year, and the Australian economy was really booming. And the housing prices have also been down. Was the last time they released the housing prices for Australia. They were down 1.7% on average, and this is after several years of a real boom. I mean, you can see that the housing prices were just soaring from 2009 to 2010 in Australia, and now they're starting to drop. Well, whether or not this is going to be the drop of a housing bubble, nobody really knows. I think it probably could just be a natural cyclical correction. I mean, a bubble implies that there's minimal intrinsic value underlying prices, and of course there is intrinsic value in Australia because it's it's a very prosperous economy. It has a very high per capita GDP, but nonetheless, it's really been riding on the coattails of China's explosive growth, and China's doing everything they can to slow down this growth. So it's only natural that there's going to be some type of a decline, particularly if commodity prices are to decline further. So we've got those factors coming into play, and of course we're having they're going to release the meetings from the RBA's last meeting this week, but that's going to come. Remember that they had that meeting before the employment report was released, so that may end up being a non-event because they don't have the new factors, they don't have the new statistics to take into consideration. And you've also got the U.S. stock markets, which are responding to a degree to the situation in Europe, of course, because it does threaten a contagion that could spread in terms of increasing credit spreads all over the world, as it did last year before they founded the European Financial Stability Fund. So if you look at the S&P, it's in a pretty tight range here. It's got a clear base of support around 1320, and it looks like it's got a strong ceiling here at 1360. And it's obviously going to break out. It may not be this month. It may not even be until later in the summer. It might just stay range bound in a narrowing range. But a clear break below its 50-day moving average, which is around 1323, that could be a clear signal, that risk appetite is starting to falter and the problems in the world are just starting to mount up. And the Australian dollar would be very likely to fall under those circumstances. And you've also got, we do have the continuation, we're going to have another month to go, of the quantitative easing scheduled by the Fed. They released it this last week, and you can see that they're going to be purchasing more treasuries, and that's going to be up until June. So that's going to try to put some type of a floor under the stock market. It's unclear whether or not we'll have a clear break in that while this quantitative easing is continuing. But if you look at the big players, the people who move the financial market, like the big fund managers who go in and purchase millions of dollars of stock every day, or large banks and traders in these carry trade instruments, they may be taking profits because they may be looking ahead and they're saying, well, 2 months from now that floor of liquidity just isn't going to be there, and I might as well take my profits now. So that's very likely to happen over the next few weeks. And while as I said, while the quantitative easing is going on, it may put some type of downward pressure on the dollar. But we've got some patterns that have formed in the Australian dollar US dollar pair. You can see that it looks like it's got a head and shoulders. That tends to be an overused pattern that just doesn't always work out. But here it really seems like there's a line in the sand right around 105, and a move below that I think could very easily take the Australian dollar all the way down to parity again with the US dollar. And you've also got a magnified chart here. You could see that some of these major moving averages it's still way above its major moving averages, but it's starting to weaken in terms of some of the other crosses that you can look at. I do like these crosses here. And the US dollar index has made a clear break out of its downward channel, and that's a pretty significant break, and it's even established itself in an upward channel right now. So as long as this break holds, I think that we're going to be in a new upward channel on the US dollar index. So what you want to do is look for the type of pullbacks, and this looks like it could be just around the top of its channel. So we could see a pullback here, and we could also see, depending on how well these meetings with the EU go, we could see the Australian dollar move up to 106.5, the 107 level again. I'd be inclined to short up there, even though I already have a half a position short. And of course it also depends on what goes on in the stock market and the commodity markets, and that's going to be impacted by the meeting of the EU finance ministers this week, of course, because the EU taken as a whole is a $15 trillion economy. So and they really most of their bigger economies are doing extremely well. Germany and France are doing well, but of course they've got this disparity going on, and it's not really a situation where there's any type of simple, easy solutions. So if you see credit spreads start to spike up, and you see the volatility index spiking up, and you see a lot of these other market paying attention more to problems, then that's going to add to the potential for the Australian dollar short. So that's likely to happen in this week.